What's up, you guys? Boris here with today's Daily Finance Talk. Thanks for tuning in. I want to take a moment and introduce you to my 11-year-old Matthew. I'm always educating my children about finance. However, today's public education system is really lacking financial education. Children are not graduating school equipped with the necessary financial tools in their arsenal in order to become successfully financially independent adults. We're training children to be good employees as opposed to successful entrepreneurs. I want to broaden everyone's financial horizon, really challenge the conventional financial education that's taught to us in public education, really challenge those norms. Open up a book and list a podcast and really broaden what your conventional mindset is about education. Thanks, you guys. Let's jump into content now. Alright, you guys, we're talking about impending doom, the financial meltdown of 2021. And in order to really determine our forward-looking guidance, what's going to take place next year, we need to really take a thorough look at the financial crisis of 2008, a subprime mortgage crisis, and draw parallels to today's economy to then determine our forward-looking guidance, the trajectory of our economy. Going into 2008 and prior, the real estate market was booming. You were sure to make a profit had you purchased a property and then you sold it 2 to 3 years later due to rapid price appreciation. And as a result, the mortgage lending industry was booming. The bankster-gangster lenders were making a ton of profit originating these loans. And then once they originated these loans, they would then bundle them up as a security, known as a mortgage-backed security, and then they would sell it on the secondary market. The largest buyer of these mortgage-backed securities on the secondary market is Fannie Mae and Freddie Mac. These are like quasi-government agencies. They're known as GSEs, government-sponsored enterprises. The federal government is basically insuring these investors against loss. And the reason the government would want to do so is because they want to stimulate the economy. They want to stimulate the housing economy. They want to ensure home lending remains accessible and affordable. So lenders would fund these mortgages. They would then, originators, they would fund these mortgages and then they would bundle them up and sell them, and they were insured a marketplace because Fannie and Freddie would always be willing to purchase these MBSs, mortgage-backed securities, as long as the mortgages are originated according to their standards, their underwriting standards. Then what segued into the 2008 financial crisis was what's known as subprime lending. Basically, these same bankster-gangster lenders got greedy and they wanted to broaden their customer base. So they created a new security, a new financial instrument known as subprime lending. Basically, individuals that were not candidates for lending, they wanted to get them into loans to basically make more profits. So they came up with these subprime lending, these ninja loans, no income, no job, no asset loans. So what better way to explain a complicated concept than to have a beautiful model explain it? So I'm going to play a video from the popular movie The Big Short, in which Michael Berry shorted the housing market. So let's check this video clip out.
Here's Margot Robbie in a bubble bath to explain.
Basically, Louis Ranieri's mortgage bonds were amazingly profitable for the big banks. They made billions and billions on their 2% fee they got for selling each of these bonds. But then they started running out of mortgages to put in them. After all, there are only so many homes and so many people with good enough jobs to buy them, right? So the banks started filling these bonds with riskier and riskier mortgages. Thank you, Banjo. That way, they can keep that profit machine churning, right? By the way, these risky mortgages are called subprime. So whenever you hear subprime, think shit. Our friend Michael Burry found out that these mortgage bonds that were supposedly 65% AAA were actually just mostly full of shit. So now he's going to short the bonds, which means to bet against. Got it? Okay. Now fuck off.
Lender said, well, we need more customers. In order for us to keep making this insane profit, we need more customers. So they came up with subprime lending, and that's what really developed into the financial crisis. It was a result of subprime lending, and also what's finally known as ninja loans. No income, no job, no assets, no problem, you get a loan. Who in their right mind would give somebody a loan that has no income, no job, no assets? Well, that's what our financial crisis was basically predicated upon. The reason being is these lenders were willing to loan to these people who are really not the best candidates, because the theory was home values would continue to appreciate. You could then, in the future, even if you couldn't pay your mortgage, you could basically refinance because you would have equity later on, or you could sell for a profit. But these these subprime mortgages and these ninja loans were riddled with one major problem. They were variable rate mortgages. So they were offered a teaser rate, and when these teaser rates would then expire, the payments would jump and they become unaffordable for these home buyers. In 05 and 06, we saw a lot of rates increase. And then around 2007, we saw a massive wave of foreclosures develop. So I put this here in parentheses, 2-year lag. I want to bring that to your attention. If you notice that the interest rates initially started increasing in 05, however, we didn't see a massive wave of foreclosures develop until 07. There was a 2-year lag. And I want you to the reason I brought that to your attention is because I want to draw parallels to today's economy. If we do see a massive wave of foreclosures developing, what's the time span in which we could see that really affect housing values? So just keep that in the back of your mind, you guys. Moving forward, then around in 2008, we really saw the apex of the foreclosure crisis. We saw 3.1 million homeowners in foreclosure, and we had 11.1 million people unemployed. As a result of this tremendous rush of new supply hitting the market, low price homes, foreclosure homes hitting the market, a lot of inventory flooded the market, and property values plummeted even more so, further exacerbating the financial crisis of 08. Home values finally bottomed out in 2012. Now, coming into 2018, we're on pace for a really strong economy. Property values in 2018 finally returned to their 2008 pre-recessionary lows. And the Fed decided to reverse course and start gradually increasing rates. And here's a chart of rates. And as you can see, we had rates up in the 5.5 range, pre-recessionary lows, pre-recession into 2008. And then here's rates crashing through the recession. And we kept rates really low through 2015. And then in 2016, 17, 18, we gradually, even though this looks like a steep pace, it was very incremental. We gradually started increasing rates. And then in 2018, the Fed increased rates, and the housing markets had a very adverse effect, and property values dropped by 10 to 15%, as much as 15% in some of the highly appreciated neighborhoods such as California and Manhattan, New York City. And the Fed said, whoa. Also, the stock market had crashed as well. I didn't mention that. And the Fed said, whoa, let's reevaluate our austerity measure, and they reversed course and decided to then start lowering rates again. Here's the chart in 2018 when they reversed course and started lowering rates again. And I just wanted to make one note that corrections are a healthy part of a cyclical economy. We need no marketplace should increase at nearly a vertical line. We should have a nice gradual increase. And then we should have corrections along the way, hills and valleys, to then go higher. Corrections are necessary in a cyclical economy for the marketplace to correct to then go even higher. Without corrections, what we're developing is an ultimate bubble. And what takes place when you prick a bubble with a pin? It's going to pop in your face. So I put that question to you guys out right now. Just think critically. Do you think that the federal government is developing a bubble in stock market valuations and real estate valuations? I'll leave that question out there for you guys. Now, moving forward into 2019. We had one of the strongest economies of all time in 2019. We had record low unemployment, record high GDP, and in the face of this, the Fed continued to stimulate rates and stimulate the economy in a already strong housing market. As I mentioned before, the economy is cyclical, and we need corrections. And this is not a natural phenomenon to have corrections as high as 10 to 15%. So moving forward, going into 2020 now. The Fed continued to lower rates in the first quarter of this year. Homeownership was booming. Price valuations were soaring in the real estate market. And then COVID-19 happened. Unemployment rate was now 12.6 million people. We have 3.6 million people in mortgage forbearance. So what's the uncertainty going forward? Can you say definitively our housing market is going to crash? Our real estate market is going to crash, or is there uncertainty about this? Now, coming into 2020, our economy was really rocking and rolling. The Fed continued to lower rates in the first quarter of 2020. Home ownership was booming, price valuations were soaring, and then COVID-19 happened. Unemployment rate soared to 12.6 million people. We had more people in for mortgage forbearance as of today, 3.6 million, than we had in foreclosure in 2008. So these numbers are really, really bad. So can you say that definitively, with these nasty numbers, can you say definitively that the markets are going to crash? The stock market is going to crash, the real estate market is going to crash, everything is going to crash and burn. Can you say that definitively, or is there uncertainty of what's going to happen next? The reason there's uncertainty because the government is artificially stimulating the economy. It's not a natural capitalistic system, and these artificial stimulations by the government have created uncertainty. The uncertainty of what's going to happen when these artificial stimulations come to an end, or whether they will come to an end, and when they will come to an end, and what's going to take place next once these government interventions come to an end. So we have, despite having 3.6 million people in mortgage forbearance, they aren't in foreclosure. They're in forbearance because the government has instituted a moratorium on foreclosures and evictions until the first quarter of 2021. And then furthermore, the government has extended unemployment benefits. I have friends who are receiving more money in unemployment than they had when they were working, and they didn't want to return to work as a result. So the question is, how many people who've taken advantage of mortgage forbearances, and how many people who've taken advantage of unemployment benefits are really opportunistic, or how many people really need the benefits? I'm not downplaying that these are vital and necessary social programs, and they've created a lifeboat for a lot of individuals, and thank goodness for that. However, there's also a segment of people who are opportunistic, people who simply did not want to work and want to collect unemployment, people who simply did not want to pay their mortgage as opposed to put into the stock market and make handsome returns as opposed to making their mortgage payments. If you call your mortgage lender today and say, I want to take advantage of mortgage forbearance that the federal government has mandated, there is no questions as to whether you're eligible. There is no fitness test. There is no hardship necessary. You simply have to ask for it and you will receive it. So how many people out there decided not to pay their mortgage and could have otherwise? So that's the uncertainty. When these programs end, how many people will get current on their mortgage? How many people will return to work? And as opposed to how many people will remain jobless, and how many people will fall into foreclosure? That's the uncertainty. The question, let's think critically. What's the major difference from 2008 than today? In 2008, housing prices rapidly plummeted. People weren't able to refinance. People weren't able to sell. They strategically walked away from their homes and went into strategic foreclosure. The difference today is property values have continued to increase rapidly at a rapid pace. The stock market is at all-time highs every day. And why are property values so high? Let me give you the dynamic. Today's COVID supply and demand dynamic. It's really unusual. But basically, the Fed is keeping rates low, stimulating the economy. There's a lot of buyers out there looking to lock in a low 30-year rate on a mortgage and buy a new property today. However, inventory is low because sellers are scared to list their home. There's COVID fears. They don't want strangers walking through their home. So as a result, demand is high, inventory is low, property values have been soaring. That's the major difference from 2008 and today, is a difference in property values. So if somebody's in trouble and they need to sell their home or they need to refinance their home, they're able to do so today as opposed to in 2008. Now, looking forward to 2021 and beyond, are we looking at a rosy situation or more of a doom and gloom stock market crash situation? There's some variables we need to consider in order to really formulate an educated opinion about what's going to take place going forward. Things to consider is, if there's a COVID vaccine, will it be effective? Will it be widely distributed? How quickly can we get it to the masses, and how effective will it be? Also, unemployment. Will people be able to return to work rapidly? Unemployment is a very, very important variable we need to consider, because the reason being is that 2/3 of our GDP is consumer spending. When people are unemployed, they go out and spend. When people aren't spending, businesses are laying off people, and it's a vicious cycle. You're not spending, you're unemployed. You're not, as a result, more people unemployed. As a result, more people get laid off. So it truly is a vicious cycle. Unemployment is a very important variable to keep in the back of our minds. Government protections. Will the government rapidly end these social programs? With Democrats, I try to stay out of politics, but generally speaking, with Democrats taking office, they tend to be more focused on social programs. So I don't see them ending these social programs rapidly. They're going to taper off very, very gradually. If you look back at 2008, these unemployment benefits were extended onward and onward and onward, and seeming indefinitely. These foreclosure protections kept being renewed and renewed by Obama. And I see another Obama mindset in Mr. Biden in the way in which he governs. And I don't want to talk politics, but these social programs need to be tapered gradually, not rapidly. You can't pull off the Band-Aid in this sort of situation. It's not going to be helpful towards a recovery. So going forward, I feel that there's a lot of optimism. I'm not pessimistic. In fact, I'm buying real estate right now. What's up, you guys? Boris here with today's Finance Talk. Thanks for tuning in today. And I'm here with my 11-year-old Maxim. Excuse me, my 11-year-old Matthew and my 5-year-old Maxim.
Yeah, hi.
Sorry, I screwed that up. I screwed up my kid's name. That's why I just called them number 1 and number 2, and that makes life a lot simpler. Really think critically what your thoughts are about what employees as opposed to entrepreneurs. So I want you guys to really critically think. I want you to broaden your horizons, join a podcast, open up a book, but really challenge what conventional education is providing, and really. What's up, you guys? Boris here with today's Finance Talk. Thanks for joining us. I'm here today with Maxim and Matthew. Matthew's my 11-year-old. Maxim is my 5-year-old. Say hi, you guys.
Hello. Hi.
And I encourage everybody to really finance. What are we? No, what? And my 5-year-old Maxim. Come closer, Max. And I just want to say that today's public education system is not properly equipping. Equipping. Yeah, is that the right word? Equipping. Equipping. But it sounds funny when you say like equipment, but like equipping. It doesn't sound right.
Equipping.
Let's do a thorough analysis, you guys. My style, the financial talk show style.